Of course you want to double your money. Who doesn't? The rule of 72 states dividing 72 by a given fixed annual rate of return results in the rough estimate for the number of years it will take for you to double your original investment. Ready Capital Corp, stock ticker RC, has a dividend yield of 11.15%. If this dividend yield was to stay consistent for the entirety of your investment timeline, it would take roughly 6.5 years for you to double that original investment. Now, is this likely to occur, or is your money better spent somewhere else? Let's get into it. Ready Capital Corp, a mortgage real estate investment trust, or MREIT, is currently trading at a share price of $15.14, giving them a market cap of $1.078 billion. RC's 52-week range has a low of $10.63, and they are currently trading at minus 9.77% from their 52-week high of $16.78. Ready Capital and other MREITs alike generate income by profiting off the difference between their cost of borrowing and the revenue which they generate from residential mortgages and small business loans. Ready Capital's earnings history over the past year has been pretty good, with their last EPS reported to be $1.95, resulting in a PE ratio of 7.78. Remember, these are real estate investment trusts, so don't look into that PE ratio too much, as company earnings are manipulated by depreciation and amortization. As I said before, RC's dividend yield of 11.15% gives you an annual payout of $1.68 per share, which is split up into quarterly payments. Additionally, they have a payout ratio of 92.56%, which is not at all too high for a REIT, as they are required to pay out at least 90% of their annual earnings to shareholders each year. Although Ready Capital has a high dividend yield, which I'm sure many people would label as a dividend trap right off the bat, they do offer that ideal payout ratio and have been able to keep their payouts consistent through the bull market up until that 2020 economic turmoil. It seems lately, however, they have had trouble keeping consistent payouts, but we know management is attempting to match historic levels as seen by the extra special dividend in March 2021. These distributions are generated by Ready Capital's three-pronged approach of SBC loan acquisitions, small business lending, and residential mortgage banking. Said approach has guided RC's balance sheet in the right direction, with a price-to-book ratio of 0.99 and a current ratio of 5.48. They currently have $467.44 million in cash on hand, which is submerged in $7.48 billion of debt obligations. Although that may seem pretty intimidating, the current ratio of 5.48 signals that their short-term assets far outweigh their debt obligation over the next year. Given such massive amounts of debt, it is important that we look at the debt-to-equity ratio of Ready Capital, which is currently 5.4 and communicates RC's ability to finance their operations using debt versus their wholly owned capital. A higher debt-to-equity ratio generally signifies a riskier investment, whereas a DE ratio below 1 should be a very safe place to park some money. Although this high leverage business model is inherently more risky, it does provide Ready Capital with the ability for aggressive growth, as well as large distributions for their shareholders. This can be seen over just the last year alone, wherein RC has almost doubled their total debt and equity to $8.213 billion, with a large shift from majority securitized debt obligations to credit facility repurchase agreements. RC has most recently reported profit margins of 24.66% and operating margins of 32.7%, with a return on assets and return on equity of 1.7 and 11.64% respectively. These preferable fundamental metrics are reaffirmed by Ready Capital, and management has been effective in 2021 thus far, raising their distributable return on equity 2.9%. Furthermore, profitability has looked good recently, with Ready Capital raising their weighted average coupon, or WAC, significantly. This measures the average rate of return of a group of mortgage-backed securities which are to be paid over different periods of time. Now that the boring fundamental metrics are out of the way, let's crack open the portfolio. Ready Capital's invested equity is weighted very highly, with 62% in SBC loans. Although they are ranked 5th of the 12 Freddie Mac small balance loan lenders by volume, it is concerning that such a large portion of the equity does not provide any more earnings potential than the lower weighted investments. The SBC portion of the portfolio is further broken down into different property types, with the largest weighting in multifamily units at 45%. These investments have supplied Ready Capital with a 32.3% compound annual growth rate, or CAGR. The next portion of Ready Capital's portfolio is their small business lending, which helps guarantee small business loans to companies with less than $15 million in net assets and $5 million in net profits. This portion of the business offers much more diversity, with 19% in lodging and 55% distributed into the other conglomerate. These investments have proven incredibly successful for RC, with a much larger CAGR of 79.4%. The last portion of Ready Capital's investment portfolio is their residential mortgage banking, which operates through 13 retail branches across 5 states. We can see the aggressive style of RC here again, drastically increasing their purchase volume and refinancing in 2020, which I believe to be one of the reasons that their weighted average coupon has taken a sharp drop. Now that we've seen how impressively Ready Capital has directed their business operations over the last 2 difficult years, let us see how this is translated to the stock chart. Trading at $15.14, RC's 2-year chart has recently begun to see a small correction after their lengthy rebound since 2020. As the price has leveled off, shown by the gray 200-day moving average line, it is difficult to guess whether it will continue to grow or not in the short term. With that being said, analyst targets currently give RC a rating of 1.9, which is a buy. They seem optimistic, but I am unsure given the economic uncertainty that REITs will face in the future. Given the rising interest rates, especially those with debt obligations as large as RC. To paint a better picture of this, we can look at Ready Capital's risk ratings. Although the company has reported to be less risky since Q1 of 2020, this was in an economic climate with non-existent interest rates. Yes, other issues were present, but with the value of mortgage-backed securities fluctuating at the Fed's discretion over the next 3 years at least, I question whether Ready Capital will be able to remain less risky. For a mortgage REIT, however, and compared to some of the other ones we've looked at on the channel, check them out in my stock analysis playlist. I do like Ready Capital as a value investment, given their superb current ratio and RC's recent showing in efficiently managing their distributions, which we've seen through their payout ratio and dividend payout history. I believe that the dividend and income they provide will remain safe. I am much less confident, however, that Ready Capital will see any shareholder returns in way of price appreciation, at least not with a short-term investing time frame. If you found this fundamental analysis and due diligence helpful, smash the thumbs up for me. Please let me know in the comments some more tickers that you would like to talk about now that we're doing all stock analysis videos. The list is starting to wear a little thin. Subscribe to the channel. As always, I'm Patrick Zimmerman. Thank you for your time. Have a nice day.